Hi, everyone. Thank you so much for joining us for our webinar today with guest Michele Garbus. She's going to be talking about the true grit of mortgage note investing. And as you know, through sign up on the email and website, this is a two-part webinar. So when Michele sent everything over to me, I'm like, this feels like a lot of really good material. I think maybe the best way to present it would be to break it up so that we can also get some questions answered. So we're going to be taking questions throughout the webinar. I do want to make sure that Michele has plenty of time to cover all of the material in this first part. So if we don't get to your question, we'll readdress questions again at the end. So I'll take a few periodically and then again at the end of the webinar. So thank you again for joining us. My name is Larissa Greene. I'm with Advanta IRA, and basically what we do here at Advanta is we hold self-directed IRA and retirement accounts. And so for those of you that aren't familiar with what we do, I'm just going to give you a quick overview and then I'll turn it over to Michele. I want everybody to know that we don't unmute attendees on this webinar, but we do take questions through the question box. So if you do have questions, go ahead and get them typed into the question box. And like I said, we'll be answering questions throughout the webinar. Advanta IRA is a self-directed IRA administrator. That means basically that we hold accounts and allow you to find the investments. Those investments are going to be anything outside of the market, and I'll show you in just a minute the kinds of things that we're seeing here at Advanta. But we've been doing this for almost 16 years now. We have 2 offices. We're in Largo, Florida, and we're also in Atlanta, Georgia, but we can handle accounts nationwide and even worldwide. So anybody that has a US-based retirement plan, we can help. Just keep in mind that we provide a service. So we hold the account, you find the investment. That's very important. And when Michele starts talking about mortgage note investing, remember that it's completely up to you, the investment strategy that you go with. And so we're here to help you. We're here to make sure your investments get titled properly in the name of the IRA. And so in this case, the lender on that investment would be the IRA. But then it's going to be up to you to really decide what that strategy is going to look like for your retirement account. Just keep in mind that we don't give any legal, tax, or investment advice, so we're here to help you understand the rules and understand self-directed IRAs. But if you have a question for us, like how do I make sure this investment is going to be a good return, or who prepares the legal documents, you can ask us those questions, but we're going to refer you out to professionals who have helped our clients in the past. And I always tell people, check with your CPA, check with your attorney, because they may be able to help you with some of your due diligence and legal documents as well. Even though they might not be familiar with self-directed IRAs, they're going to be familiar with the other things that you've made investments in the past and may be able to assist you. Why haven't many people heard about self-directed IRAs? Well, the honest truth is that there are just not a lot of companies out there like Advanta willing to hold what brokerage firms might consider hard to value assets. And so they really want to hold things that, first of all, the way they make their money is commissions on sales of investments. And again, just a reminder, we don't sell anything. And so that's not how we earn our keep. But also they can look by the day, by the minute, by the hour, and see what the value of those investments are based on what it's trading at. And so most of the assets here at Advanta are updated on an annual basis because there's no real good way to take a screenshot and say, okay, that's how the value has changed over the last few days. And so we're very familiar with that process, but somebody like Charles Schwab, Morgan Stanley, although they're great companies, they're just unwilling to do the legwork that comes along with self-directed types of assets. And just a little note here that actually less than 4% of all retirement accounts are truly self-directed. So many brokerage firms will offer a self-directed type of investment plan, but what they're doing basically is allowing you to choose the investments and how much you want to allocate to each investment. And so that's kind of different from the definition we have here at Advanta for self-direction. I always like to tell people or give you an idea of the types of accounts that we see, because a lot of times when I meet people, they say, well, I don't have a Roth IRA, so I can't invest in things like mortgages and real estate. I'm not really sure where that statement comes from, but the truth is if it ends in IRA, it can be self-directed. And then you can see up here the other types of plans we can self-direct as well, including solo 401ks, health savings accounts, and education savings accounts. And also just to kind of add on to that, any type of old employer plan can be self-directed. So just keeping in mind, if you've left a position, if you've left a job, and you have an old employer plan sitting out there, whether it's a 401k, a 457 plan, a 403b, any of those can be self-directed simply by moving the funds over to an account with Advanta, and then you can choose those options rather than have that old employer plan sitting out there and not really doing anything or having any growth for you. Also, we talked very briefly about health savings accounts and education savings accounts in other webinars that we do. The rules for self-directing those accounts are going to be exactly the same. And so we can also hold those accounts so that you can self-direct them. And we see more health savings accounts than we do education savings accounts, but those are both great plans. And if you're wondering more about those, please feel free to reach out to me after the webinar. Really quickly, I just wanted to show you guys a list of different assets that we see at Advanta, because a lot of times we talk about real estate and real estate-based assets like we're going to talk about today, but there are so many different things that you can invest in with a self-directed retirement account. And really, it's just about the sky's the limit for these accounts. Now, there are some rules. I'm not going to go into those, but you can join us for just about any other webinar that we teach where we go over the rules very specifically. You can also check out our YouTube channel for those. But real estate-based assets, just about in any form. We see a lot of paper assets like mortgages. We also see tax liens and unsecured notes. At times, I've seen people use options for real estate, assignments, a lot of joint venturing, accounts receivable. And then the other alternative assets are going to be what some people may consider very unique, like farm animals and movie projects, or things that are maybe more commonplace like LLCs, private stock, and foreign currency exchange. So there's a lot of options out there, but that's really just to give you an idea of what we see on a regular basis here at Advanta. So we actually do an entire webinar on being the bank in your self-directed IRA. And, there's a lot of advantages to that, and I'm sure Michelle's going to cover that in great depth. But just to give you an idea of what you're looking at, when you go and borrow money from a bank, they say, okay, this is what we're willing to do for you, take it or leave it. And so when you're the bank with your retirement account, you get to do the same. And so whether or not you want to do something short-term or long-term and have it based on, maybe a fix and flip or, a 15 or 30-year mortgage. Again, we've seen unsecured notes or notes secured by other things like farm equipment, automobiles, and livestock. All of those things are options available to you. You just want to make sure that when you're looking at an investment, you're comfortable with it. And again, when you're the bank in the scenario, you get to determine the amount you're going to lend, the interest rate. Is it amortized or is it interest only? Are you willing to lend for 6 months, a year, 15 years? Is there equity participation if this is a rehab project? And are there payments, or is it just one balloon payment at the end? All completely up to you. And the interesting thing about a mortgage is that when it's secured by real estate, when you have something secured by real estate, you get to really have that, real estate type of investment, and then you also don't have to worry about tenants, toilets, and termites. So you're also determining the rate at which your IRA is going to grow. So if you're willing to lend at 8% or 10% or 12%, you know that as long as your borrower pays, that is what you're receiving back to your retirement account. There's a lot of benefits, as I mentioned. You get to act as a bank and determine the terms. There's less liability when you have a mortgage in your retirement account versus actual real estate. It can be a very low maintenance investment, and you can partner funds. And so if you're just getting your retirement account started and you have 20 or 30,000 and you have somebody looking to borrow 100,000, you can put IRAs together in order to lend that money out. So just some things to keep in mind when you're thinking about using a self-directed retirement account. And so with that, I want to introduce Michele Garbus. How are you doing today, Michele?
I'm doing well, Larissa. Thank you so much for having me and Advanta. And good morning or good afternoon, everyone, depending on what coast you're on. I was telling Larissa that 2 days ago, I'm in Colorado, and 2 days ago we actually had snow here. So if you can believe that, that's not typical for Colorado, but it happens. So anyway, what we're going to talk about today is really getting into the nitty-gritty of mortgage note investing. And I have represented here two different companies, Ariel Funding and Real Property Financial. And the reason for that is Real Property Financial is our property management company and our marketing company. When you invest in notes, and what we're going to talk about today is really mostly non-performing notes, although our companies invest both in non-performing and performing notes. But when you invest in non-performing notes, you occasionally end up with the real estate itself. And so we developed Real Property Financial to be the company that manages that real estate, and also our marketing company. Ariel Funding is the company that we actually hold our mortgage notes in. And the reason it's called Ariel Funding is because my husband, who is a partner of mine, is a big airplane enthusiast. So that's kind of the name we came up with. So there you go. So one of the things that I believe in is not just talking about all the opportunities in notes. I am going to talk about opportunities in notes, but I also really want to give you the things that make notes worthwhile, but talk about how you mitigate risks, especially in an IRA or 401k, because the last thing you want to do is put your retirement funds in danger. So a big part of that is really looking at notes and making sure that when you're investing in notes, you're mitigating as much risk as possible. So I'm going to talk about that. And so the two things we're talking about today is the opportunity with the notes and also mitigating the risk. Next week on part 2, we're going to talk about really getting into the dirt. And I know a lot of people always ask me about pricing for notes. And so we're going to talk about that pricing for notes, as well as what happens when something major happens. How do you get out of that situation? And what other additional ways can you look at risk and make sure that you're prepared for that? And how do you get out of that? So that's what we're going to be talking about on this webinar. And so first I wanted to tell you a little bit about my background and how I got into notes investing. I am very passionate about notes investing. And one of the reasons for that is I've done a lot in my both mortgage and real estate career. And by far, notes investing has been the best thing that I've done. And you'll see why, I think, as we go through the next few slides. But I started out in the .com industry, in the computer industry in Silicon Valley, and I used to turn in both companies and divisions around in my background. So through that, I had a fair amount of financial background and really running big companies. But unfortunately, that's kind of a painful process when you're Excuse me, I have a little bit of a cold. So when we're turning companies around, you're voted in by the board of directors, and at that point, everyone expects you to fire them. So it's kind of a brutal career when you're doing that. And also, I wasn't really making the money that I felt I wanted to make for my retirement years. So I decided to get into the notes industry through primarily opening a mortgage brokerage. I felt the best way to learn that is by having a mortgage brokerage. So that's what I did in 2003, and we did generate our own hard money notes through that company and did very well with that and learned a lot about mortgages that way. Well, in 2006, we also started investing in fix and flips, short sales, subject twos. In fact, I was the top short sale specialist here in Colorado, and we did over 100 properties that were short sales. And if you know anything about short sales are probably one of the most painful things you can do in real estate. So during that process, when 2008, 2009 hit, I started working with financial institutions that I was talking to about short sales. And those people came to me and said, we have a lot of distressed assets. Do you have any interest in purchasing these distressed assets? And so I took a look at them, and at that time the pricing was such, it made a lot of sense for me to do that. So that's really how I got into non-performing notes investing, and really felt that since I had the background in fix and flips and short sales and all of that, it really lent to me being very successful in non-performing notes. So we actually changed everything that we were doing in our company and have been purchasing non-performing notes since 2012. And through that time, we've successfully managed through getting over 500 notes either reperforming or paid off or we foreclosed on. So at some stage, there was an end to the note unless they're still reperforming, which we do have notes that are still reperforming for us to this day. And so we looked at the end of last year at our success rate, and we've successfully gotten 72% of all of our notes either reperforming or paid off. So let's talk about the opportunity for notes. Oops, I think I skipped a slide here. Sorry. In your IRA and 401k. So one thing that we are very conscious about, especially when you're investing in your IRA or 401k, is you don't want to do anything that's going to damage that, because that is your retirement. And it's one of the things that I really love about notes is that they have a lot of benefits for your retirement funds. And the first one is that it's really a tangible asset class that can be purchased immediately. It's something that you can find. A lot of real estate investors are having a hard time finding good real estate investments at this point, but with notes you can still find them. You have to certainly be more careful about what you purchase now, and we'll talk about that in greater detail. But it is something that you can purchase immediately and can immediately help your IRA or 401k. Also, notes, as Larissa was saying, are secured by the real estate. And so you have a tangible asset there that if you need to, you can go after. You can put in a small or a large amount of capital. And what I mean by that is some notes that you purchase, you're actually purchasing them at a discount, so you don't necessarily need to have a lot of capital to purchase a note. The other thing that you can do is purchase a part of a note, which is called a partial. So they are easily titled and worked with the custodian, and Larissa talked about that to some degree. It's something that they do all the time, and certainly you need to work with a self-directed company like Advanta. And there's also diversity in the types of notes. And so what I mean by that is that you can buy first or you can buy second mortgages. And certainly we'll talk about risk between first and second mortgages. You can also buy non-performing, as we talked about, or you could buy performing notes. There's also numerous exit strategies, and we're going to talk about those exit strategies in depth. You can also get consistent cash flow with good performing notes, and that's key in an IRA. If all you want to do is have a very secured investment and you want to grow your IRA, you can buy a performing note and make the interest on that note every month to help grow your IRA. The other option is you can possibly get accelerated growth. And what I mean by that is we talked about you can buy notes at a discount. So we've had many instances where people have just paid us off. And in this market, when you've got interest rates that are so low, you might be purchasing a mortgage note that has a much higher interest rate. So it would make sense for them to either pay you off or get it refinanced and pay it off that way. So in that situation, when you're buying at a discount, you can get large amounts of capital infused into your IRA or 401k. So the other thing that is wonderful about notes is that there's really no UBIT concerns. There's one exception to that that I know of, and that is when you're purchasing both a first and a second on the same property. So you have your own company, for example, buying the first, and then you have your IRA buying the second on the same property. Well, what happens if you foreclose? When you foreclose, you would want to foreclose from that second position because you don't want to wipe yourself out. So if you foreclose from a second position, then all of a sudden your company owns that first. So in reality, you would have then a first mortgage loan in addition to your second mortgage there, and that would create a UBIT concern. So there's ways to get out of that and not do that. One is you could not purchase the first and the second, but the other one is if you do end up going down that road, you would just want to sell it, and you can sell the note or the property immediately, so you don't actually own that first mortgage within that property when you own the second as well, for the property itself. The next is there's no rental liability. As Larissa was talking about, you don't have to deal with tenants. You don't have to deal with toilets, and termites is a new thing for me. I haven't heard that term, Larissa, but I think that that's funny. So anyway, you don't have that rental liability. You don't have to worry about somebody that trips on your doorstep or whatever, because you technically, with a note, you don't own the home. You have a lien on the home. The homeowner owns the home. So they have to deal with that. They have to deal with the roofs and all of that type of thing. So it's a nice opportunity within your 401k. Then lastly, it's an amortized loan. So you're getting all of those interest benefits. And so let's give you a really great example of that. So let's say that the home is worth $100,000 and you end up buying the note at $80,000. Well, that note is what that homeowner is paying on of $100,000, because that's what they are paying on, because that's what the house is worth when they put the loan on it. But you are buying at a discount. So therefore, you're able to purchase that loan at 80% of what the loan is. Therefore, if they have a 6% interest on that loan of $100,000 and you're buying it at $80,000, that 6% is now a lot more. So your yield increases because it's actually going against something that you paid $80,000 for. So it makes a tremendous investment and the ability to have profits. And we're going to talk about pricing and how all of that works and look at LTVs both later in this presentation, but also in tomorrow's presentation. Or sorry, next week. Okay. So there's two types of mortgages, as I said. You can purchase firsts and seconds. One of the difference, though, is going to be risk. So obviously, first mortgages are less risky than second mortgages, and we'll talk about that. You can also buy performing, or you can buy non-performing mortgages. They come with a lower cost of investment, and it's because of that discount that I was talking about. Because you're able to purchase at a discount, and depending if you're going to buy first or second mortgages, you can actually get away with purchasing something for even a couple $1,000s in a note if you want to buy a second. But we're going to talk about the risks associated with that. You can also have diversification among multiple notes. One of the things that's so nice about mortgage notes is whether you're buying a group of firsts or you're buying a group of seconds, you can buy a number of them so that you're diversifying not only among different notes, but different borrowers, different markets, different risk factors, all of those types of things. There's also multiple exit strategies. And we were figuring out the amount of exit strategies on notes that we have right now, and there's probably over 16 different ways to exit a note. And I've never found any other opportunity, even in real estate, where you have as many opportunities to exit a note and different strategies. And what's so nice about that is that you can make sure it benefits the borrower, it can benefit yourself, and if you have investors, it benefits them as well. We'll talk a lot about exit strategies. I have a whole slide on this. So this is where we were. We were on secured liens. So they are secured by that real estate, which makes a huge difference when you're investing because you have a tangible asset that you can go after. So one of the great things about mortgage loans is that the value of the lien is going to be greater than the purchase price. So we talked about that, and that's because of that discount. That discount can make a huge deal, and we're going to talk about loan to values because your discount can impact whether you're going to be successful with mortgage notes. So you really need to understand that discount and how that plays in. Also, you can get revenue in chunks or you can get revenue in cash flow. One of the things that I love about mortgage notes is that when we're working with them, they're typically anywhere from 20 to 30-year mortgage notes. When I was working in real estate or doing hard money loans, one of the things that was really difficult is you had to turn that money every 6 months or a year, finding new projects that made sense, it took a lot of work. I mean, they were out there, but it took some work to do. And with mortgage notes, typically, what we're purchasing in a non-performing fashion is anywhere from a 20 to 30-year mortgage note. So when we get them performing, that means we're going to have that long in terms of income coming in. So people would say, well, yes, but typically people refinance or sell a house every 7 years. Well, that's true, and we have some things that we've put in place to try to make sure that we are keeping that note, if at all possible. But in addition to that, we believe that with the interest rates being so low right now, the time frame for people to do that, either buy a new house or do a refinance, is increasing. So that's something that really plays into your favor because it puts you in a situation where you're not trying to find new investments every 6 months. It provides also really long-term cash flow. And this is important in an IRA because you can get that 30 years or that 20 years in your IRA for that long of time if that's something that you wanted to do. You can also get chunks of money. And what I mean by that is we talked about a lot of times loans are paid off. And if that is the case, you're going to get that difference between that discount that you purchased the loan at and the payoff on that loan. And so that can provide you with a chunk of money. If you have to foreclose, you can get a chunk of money that way also by fixing up the house and selling it. One of the great things about notes is that you really make the rules. Because you have all those exit strategies, you're able to go in and decide what's going to be the best thing. Now, our philosophy is we always want to make sure that we're doing the best thing for the borrower, if that's possible. keeping them in their home is what we prefer to do, and it's something that we go to great lengths to try to do. And you have a lot of different things at your disposal to try to keep them in the home. But if they're not going to work with you, which happens a fair amount, then you have other options where you can make the rules in terms of cash for keys, or you can foreclose deed in lieu. There's a lot of other things that you can do, which we'll talk about. It's also a service provider industry. So we're not a huge company here. We have just a handful of people. And the reason that we do is because we have a number of people out in the field, and we buy notes all over the United States. And we have people, we have attorneys, we have realtors, we have a lot of different people that we work with around the United States that were brought up in this industry and really understand it. So one of the things that happened in 2008 and 2009 was that with that crisis, a lot of the banks really needed help with these assets. So a whole kind of sub-industry bloomed around them that's still in place today. And what's great is that they negotiated pricing with the banks negotiated with pricing with these field people that made it pretty reasonable. So I can literally have somebody go knock on a door of a borrower 3 different times, get them on the phone to our servicer, and it only cost me $70 to do that, all 3 times total. So it's nice that it's a service provider industry because you don't have to do everything yourself, and it makes a big difference. So then obviously one of the big benefits is that you can use your Roth funds for tax-free investing. So whether it's a big chunk of money or it's monthly payments, that can go into your Roth tax-free. So let's talk about those exit strategies. The first one, when you buy a note, is you can wholesale it, that particular note, to other investors that are interested in that type of property. And there's a number of notes investors that's all they do is that wholesaling. You can also do a forbearance or a loan modification for the borrower. A forbearance is typically used if they have a short-term situation where they've lost their job or they've had some health issues, something like that, to keep them in the home with either lower payments or suspended payments for a short period of time so that they can get back on their feet again. A loan modification is more longer term. You can do loan modifications for that 20 or 30 years if you'd like to do that. A lot of times you can end up doing both, where you can do a short-term forbearance program, and then the second piece of that, if they perform, is the loan modification. You can also get a payoff. So we have many borrowers that we did years ago, short payoffs, where we were able to take that discount that we purchased the loan at and give them a better price to pay us off because their house wasn't as worth as much as it was in 2006. As you know, we had a pretty severe drop in a lot of areas. But because we were able to purchase at a discount, we're able to help the borrower by providing them with a short payoff. Or if that wasn't the case and they just wanted to pay us off, they could do that as well. And we have that happen quite often, especially now through refinances. A lot of times when you have a second mortgage, borrowers are wanting to combine that first mortgage and their second mortgage into one loan now because there's enough equity to be able to do that, and it makes their payments lower because they're getting the interest rates on a first mortgage loan. So we get all the time borrowers wanting to just refinance us out. You can also do a short sale. So if you have a market that hasn't recovered yet, you're able to short sale the loan, which means you're letting them sell the house at a discount, which means you may not get paid off as much as what they have on the loan, but because you're able to buy it at a discount, you can let that happen quite often, still make a profit, and help the borrower out. You can also take a deed in lieu. And what that means is that instead of foreclosing on the property borrower, if you sign over the deed, then we won't foreclose, help your credit out, and you can just kind of move on. So we had a number of people in the past, this doesn't happen quite as much now, that would want to do a deed in lieu because they just wanted to get rid of their situation and move on. And so what's nice about that is it helps both the borrower so they don't have a foreclosure on their credit, and that also helps you because you don't have to go through that foreclosure process as well. One of the things you have to be real cautious about here, though, is that when you take a deed in lieu, if you're in a second position, you may have other liens behind you, or if you're in first position, you would have other liens behind you like the second. And if you don't foreclose, then it's not going to wipe those other liens out. So it's something that you want to make sure you're looking at and being careful with. You can also foreclose and fix up the property and flip it, or you can foreclose and just flip it or wholesale the property. You could also foreclose to a rental. And in this market and with the tax advantages that rentals have right now, we do this strategy quite often. If we foreclose, we'll just go ahead and keep the house and then go ahead and rent it out. And you can even do that from a second mortgage position. We've even done it to the point where we've made some of the houses Airbnbs. We had a house in Arizona that was right on the border of Scottsdale and Phoenix in Arizona, right next to a Biltmore, and we made that house into an Airbnb, and it was a great investment. Our return on it was unbelievable. You also have the hardest hit fund as an exit strategy, and this is something that people don't utilize at least enough of, in my opinion. And the hardest hit fund is something that's going to go away, actually, in 2020. So it's something that needs to be utilized. But the government, when we had everything happen in 2008, 2009, allocated TARP funds. It was $9.6 billion to the states. And those funds are geared to help homeowners out, specifically unemployed homeowners or mortgages that are upside down, that you guys can help borrowers utilize so that they can stay in their house possibly and either pay you off or get payments made on their behalf. So it's a great opportunity for people. And the last thing we're going to talk about is partials. So you can sell, when you buy and note, part of a loan. You could sell off 5 years of the 20 years, 2 years of the 20 years, anything that you want. So that's a nice thing, because especially in IRAs, if you don't have enough funds to buy a whole loan, you could buy part of a loan. And it's a nice thing as an investor because you're getting that money for that part of the loan out of the loan so that you can purchase more loans or do whatever you need. So as I said, these are a number of exit strategies that are probably the most utilized, but there's probably 16 total exit strategies that we utilize on an ongoing basis. So how do you start? So you really start by building trust with the borrower, and that's probably the most important thing, because if you do that, whatever exit strategy that you employ, you're able to communicate with the borrower and hopefully make it as smooth as possible for both them and for you. And so our philosophy is really to keep them in their home. That's what we want them to do. And if you look at the numbers on any mortgage loan, it really makes sense to keep them in their home, not only for them, but also for you as an investor. We find that we typically make better money by keeping them in their home. But the reason that we're doing that is we want them to be in the home. We're not really in the business of getting the asset. There's certainly a lot of investors that's what they want, is to just get the asset. But honestly, I think if they looked at the numbers, they would see that they would be doing better for their homeowner and for themselves by keeping the homeowner in their home. So we talk to them about how we can help them and build their trust. And a few ways we can do that is by lowering their interest rate. We can increase their amortization. A lot of these people have been paying on their loan for a few years already. And so therefore, they've amortized the loan down. Well, we can amortize the loan back up to a 20 or a 30-year mortgage, which will effectively lower their payments, which will help them. Obviously, lowering the interest rate also will help them. We still see occasionally seconds that we purchase that are still these crazy interest rates of 13 to 18%. So it's easy for us to be able to lower that interest rate to kind of a reasonable level and really help them out. We could actually reduce the debt or the mortgage amount. Again, that's similar to what we were talking about in a short sale. If we wanted to, we could say, well, you owe us $100,000, but there's been late fees of $15,000 in past due interest. And so we'll go ahead and write that $15,000 off so you don't have to pay that. That's something we can do to help homeowners out. We also can repair their credit, because if we get them into a loan modification, we can report that they're paying on that loan modification on their credit. We can also put money on the back end. So we can say, okay, homeowner, you owe us $100,000, but you really owe us $150,000 because you haven't paid us for all of this time. We can do a compromise and write some of that off. So of that $50,000, we could write $25,000 off, and we could put the rest of it on the back end of the loan. So they still are obligated to it, but it's not amortizing in the loan itself, and so therefore their payments aren't being impacted by that. But we still get those that past due interest or part of it, depending on how we want to do it, in the long run. So that's another really nice thing that you can do for homeowners. So let's talk about mitigating risks. The very first thing that you want to do in mitigating your risk is you want to make sure you have a good structure set up. So in the illustration here, I'm showing a capital structure which is being funded by an IRA or a 401k. You can put any capital structure in there, but we obviously like IRA and 401k dollars because you can do it pretty easily. But you could have a fund there. You could work with third parties. You could have your own money, whatever type of capital structure you want. But you want to make sure that whatever structure that you put in place is going to be one that works for you and mitigates your risk. With that, you have many types of assets that you can purchase with that capital structure. And of course, our asset is a note asset. The thing that I think is the most important of this slide is you always want to have reserves. So when you're purchasing notes, you always want to have money in reserve. Why? Well, one is that you can't predict what's going to happen in our market, especially right now. We seem to be stabilizing, but a lot of people think we're going to have a down market. Some people don't think we're going to have one for a while. But we honestly, none of us have a crystal ball, and we don't know. So you want to have reserves so that you can continue to pay your servicer, your attorney's fees, those types of things. And then what happens if you do end up taking the property back? Well, then you're going to probably have to rehab it, and you want to have money set aside to rehab a property. So we always recommend having both first reserves and secondary reserves in place. So in case for some reason something happens and there's not enough reserves that you've put in place for your first reserves, that you actually have a secondary reserves in place that you're able to utilize. So let's talk about due diligence. So we actually teach a 5-day class on note investing. So I'm not going to be able to go into this as thoroughly as I would love to be able to do, but due diligence is probably the most important thing that you can do when you're notes investing. And in our class, we spend almost 3 days just on various pieces of that. A lot of it includes bankruptcy and foreclosure laws, so it takes us a little bit to go through that. But it's really, really important. Remember, when you buy is when you make your money. So doing the due diligence and making sure that you're buying correctly is really important. So you want to look at the markets that you're buying in and how does that impact you. We buy all over the United States. There's a few markets that we don't buy in. Those include New York, New Jersey, and Illinois. And there's reasons for that, and we'll talk about that. But when you're looking at purchasing notes, you may want to just consider working in markets that you really know and understand. The other thing that you want to do in your due diligence is you want to look at what's the fair market value of these notes. And I'm not just saying the fair market value everybody's telling you. I'm saying a fair market value that you feel really comfortable with. And you may have a BPO agent go out and verify that that's a true fair market value. Because some notes, and we'll talk about this next week, you're actually making the offer based on that fair market value. So it's critical to understand that. The other thing that we do is we run what's called an ownership and encumbrance report, or an O&E. So this verifies that the owner of the note is actually still in place and what you're buying. We've seen a lot of second mortgages specifically where that note, the borrower, is not even in the house anymore. That note was foreclosed on, or something occurred where that borrower is not in place. And so therefore you have a note on a house that's not even real. So doing those ownership encumbrance reports protect you from that perspective. So you're going to see some things here that may, quite frankly, make you very cautious about notes. And I'm doing that on purpose because I want you guys to not only see all the great opportunities, but I want you to understand that you really need to do your due diligence on these notes and understand that anything that you do can be overcome. You just need to know how to do it. And so that's why I'm going through all of this information. So one of those things is bankruptcies. So bankruptcies, actually could be a good thing or they could be a bad thing. You obviously don't want to get wiped out in a bankruptcy. But we see Chapter 7 bankruptcies all day long, and we're fine with a Chapter 7 bankruptcy. Now, there are certain states that a Chapter 7 bankruptcy could remove the lien. Typically, with a Chapter 7 bankruptcy, the lien is not removed. It just means that the borrower is no longer responsible for the payments, but you still have the lien. And there's a lot of things that you can do when you have that lien, including a voluntary loan modification. So we can still get them to make their payments as long as they're doing it voluntarily. We can also end up foreclosing on the house and getting the asset. So Chapter 7 bankruptcies really don't bother me a lot, but we need to understand the Chapter 7 bankruptcy to make sure that what we're buying is not a stripped lien. Usually in Chapter 7, it's not stripped. That happens mostly in Chapter 13. But there are a few states, and this is what I was talking about in the markets, you need to know that market, that they can strip a lien in a Chapter 7. Florida is one of those states, and I'm sure there's a lot of Florida people on here on this call. So you just have to know the market and be aware of what's going on. The other thing is with Chapter 13. Getting payments on a Chapter 13, again, because you can buy at a discount, can be very advantageous to you because the courts are monitoring it. You get the payment every month, and it's all fine. But in Chapter 13 is where usually a lot of strips can happen, especially with seconds. So you have to be able to monitor that and look at that so that you know specifically what's going on with the liens that you're buying. The next thing is the foreclosure status. Notes can be foreclosed on, especially if it's a second. A first can foreclose and wipe you out. So you just need to know what's going on there. You certainly, as a second position loan, can cure a first mortgage. So we're not, again, afraid of foreclosure. We just need to know what's going on so that we are able to deal with it. But it is a risk that you have to be able to mitigate. There are states that can foreclose from a tax lien or an HOA lien. So you need to know that market and what's going on there as well. You also need to know if the taxes are being paid or the HOA is being paid. So there's not that possibility of them foreclosing on you. And the other thing is you may have to pay those taxes or that HOA. So when you're pricing your loans, you want to make sure that you're pricing that amount of tax into your loans because that's going to be a hard cost to you. The other thing that you really want to look at when you're doing your due diligence is the environmental status. What's going on with flooding? Baton Rouge, Louisiana just had huge flooding happen. Florida gets hit with hurricanes and all sorts of stuff. So you want to make sure that you know what's going on in that specific region from an environmental perspective. When you buy a loan, you're not immediately going to be insured. So you will, once you get a loan performing, or you put what's called force-placed insurance on the loan, you will then be insured. So your asset or your note is then protected. So there's a lot of exit strategies with foreclosure alone. So if you can't get the loan reperforming, then you have to go through a foreclosure. And with that, you can fix and flip it, you can fix and rent it, or possibly you could let it go as a second. So if you're only buying a $2,000 loan as a second, you might actually consider letting that go. And I know that sounds strange, but in some states, attorneys' costs to foreclose on a loan can be huge. We just paid like $30,000 to foreclose just attorney's fees alone in a loan that we had in Massachusetts. That wasn't a second, it was a first. So we had more money into it and we bought it right, so it made more sense. But if that was a second, you might want to just let that go if it's only $2,000 that you had invested versus spending $30,000 on attorney's fees. And you can do that with seconds, typically not really firsts. But the other great advantage when you end up having to foreclose is the possibility of renting or doing an Airbnb, especially with seconds. One of the things that's really nice with seconds is that you can foreclose on it and it's subject to the first, meaning that the first still needs to be paid off, but most times you don't have to pay that first off immediately. You can actually cure it or just make that borrower's payments. And we've done that quite successfully in the past. So our return becomes much higher, and I'm going to talk about that in another slide. So let's look at loan to value and why that's important and and when you're looking at purchasing a tape, how you analyze this is probably one of the biggest mistakes that I see investors of notes make, is that they don't look at their loan to values. And they purchase the notes too high, and therefore if they have to foreclose on the property, there's not enough margin in there to do what they need to do on rehab and attorney's fees and all sorts of stuff. So we're going to look at that. So is purchasing a loan at 70% or 80% of loan to value enough? Is that enough of a discount? On second mortgages, is 50%, if I get 50% discount, is that too much? So let's look at those LTVs. So with a first mortgage, I've given you an example here, and in this first mortgage, we purchased that first mortgage at 70% of loan to value. So if you take that 70% and you purchase a home at $100,000 versus $250,000 versus $400,000 in the fair market value of the home, you can see how that loan to value, that 70%, makes an impact. Because if I'm purchasing a loan at 70% of $100,000, I still have $70,000 into that note. Plus, if you're selling it, you've got real estate commissions, you've got closing costs, you've got rehab costs, you've got the cost of the money itself if you're getting a loan on it, and then you've got your legal fees. So even though I'm purchasing it at 70% of loan to value, I'm still losing $7,300 in this scenario. But the more that the price goes up on the house, because I'm still purchasing it at 70%, I'm making money on higher priced houses, even though you can see the cost of my money and my rehab and various things go up because it's a higher priced house. Because it's 70% of that loan to value, I'm actually making more money. So let's look at that from a second mortgage scenario. So in the notes industry, the amount of money that you pay for the loan compared to the value of the loan is called investment to value. That's that ITV number there. But with second mortgages, you have to look at both the first mortgage and the second mortgage combined, because remember, it's subject to the first mortgage if you're foreclosing. So what you need to do is make sure that you know how much that first mortgage is. So when you're buying a loan, you can price that into it. So in this scenario, it's the same exact numbers. So we have a $100,000 house, a $250,000 house, and a $400,000 house. In this case, we're looking at a 25% investment on our second. Because it's a second and it's considered higher risk, we're able to buy it at 25% of the value of the note. So the cost of the note in the first example is $6,250 for a $25,000 note. The payoff of the first is $65,000. We have those same costs involved, and that's all figured based on fair market value. And so therefore, because we're purchasing the note at $6,250, our cost of our money drops because we don't have as much money put into there. We're still losing money, however, in this scenario. But as you can see in the other examples, we're actually making a lot more money than we would in our first example. So we do find that in second mortgages, we make a lot more money, but they also carry more risk. So doing that due diligence is huge because as I mentioned before, you could be stripped of a second mortgage completely and wiped out or foreclosed on. So you've got to make sure if you're going to be doing second mortgages, you do your due diligence correctly. But in a way, you can actually make a lot more money in seconds if you do the job right. So let's look at how rent works in this scenario. So if I foreclosed and rented a property, this is typical for my returns. Again, I'm going to have still legal fees, all the rehab fees. And again, this is a big mistake I think newer investors make, is they don't calculate all of that in and find out exactly how much those legal fees are going to be and what your cost of money is, and make sure that you're putting that in there too. So when we do that, we typically find that on a first mortgage, we can make a 5 to 8% yearly return. On second mortgages, it's usually a higher return. And one of the reasons for that is because when you're renting, when you have a second mortgage, even though you have to make the payments of the first mortgage, you're not having to pay that all off immediately. And so therefore, you would have to subtract out that payment of that first mortgage every month in our example here. But because of that, and not having, you don't have to put that money up front of that first mortgage in, your cash flow is figured off of the amount of money that you have into your second mortgage. And because you're able to pay for that second mortgage at a cheaper rate, your returns are much higher. So hopefully that makes sense. And one of the other huge benefits here is whose credit is mainly at risk. Well, if you have a first mortgage in place, that credit is still the borrower's credit. So your credit is not at risk. It's really the borrower's credit in here that's at risk. And you are actually helping them by making those first mortgage payments. So that's another way that you can help your borrower. Okay, so kind of in wrapping up here, how do you mitigate your risks in a 401k or IRA? Well, obviously, with notes, it's secured by real estate in mortgage notes. There are a lot of notes out there that you can buy that are not either secured by real estate or secured at all. So I would caution you about buying those, because then you don't have any asset to go after if you need to. The other thing that you can do is just by performing. Performing notes carry the least amount of risk, especially when that CLTV or LTV is very low and there's a lot of equity, which there is a lot of those out there now. You can buy some performing notes, and because they've been performing, the likelihood of them becoming non-performing is fairly low, especially if they have a lot of equity. But you want to look at that loan to value and that equity. You can also buy non-performing and get them re-performing, or refinance out and pay you off. That's also another great way of mitigating your risk, is making sure you're buying a loan that gives you the ability to do that. If you have to foreclose, sell the property. One of the things that I would be cautious of if you're going to be renting it, especially in an IRA, is you want to have a third party do that fix up and the management, so that you don't have trigger a prohibited transaction or UBIT or anything like that. You want to have third parties involved. Also, one of the things that we do is we use third-party servicers, and that's beneficial for you in a number of ways. With a third-party servicer, you're not managing the loan, and therefore you're not going to trigger UBIT for sure, or a prohibited transaction. But the other thing that does for you in the mortgage industry, we're talking about homeowners here. So these are primary residents. You have various laws that you need to follow, and we're going to talk about some of those laws next week. But one of the things that will help you there is to make sure that there is distance between you and the homeowner by using a third-party servicer. Then you don't have to worry about some of the RESPA laws or CFPB or some of the other things that have come down that impact you. The other thing is, when we buy non-performing loans, we're not originating the loans, we're buying an existing loan. So we don't have quite the restrictions on us that loan originators do. And again, we'll talk about that next week. But one of the things I highly recommend is that you have a servicer manage your notes if you're going to be buying them directly, so that you have that interface in between you and they can make sure that you're protected and you're not considered a debt collector. The last thing is that you can use a third party to purchase your notes through your IRA or 401k. This is typically what we find is what most people do, and they can do it either directly or through a fund. That puts even a greater level of detail, greater level of barrier between you and the note itself to help protect you in your 401k or IRA. And at that point, then you don't have to worry about foreclosing. You don't have to worry about getting the note reperforming. Someone else is doing all of that for you, and you're just getting the benefit of that note.
We did have a question pop up here. Oh, that's okay. We do have a question pop up here. Could you go to magistrate to collect on small mortgages?
I'm sorry, I didn't hear you.
Can you hear me okay?
Could you go to, yes.
Yep. Could you go to magistrate to collect on a small mortgage?
I have never done that. So typically what we do is we go through the servicer and have an attorney go through collecting on a small mortgage. I've never gone through magistrate, so I can't actually answer that question.
Well, I think that was a pretty good answer, though, and I want to leave the slide up here for just a second and remind everybody, if you do have any questions, go ahead and type them into the question box. If you have questions that you would like to get in touch with Michele, there's her contact information. Remember that our next webinar, the second half, is going to be next week, so I'm going to go ahead and flip the slide over. But it's June 18th, again, 12 to 1 o'clock Eastern Daylight Time. You can join us. If you guys are not available next week at that time, you will get the recording as long as you sign up. So just make sure you go ahead and sign up for that webinar, and you'll get the recording at that point for both the first part and the second part in case you want to review it. That information is also going to be available to you on YouTube. So with that, I didn't see any other questions come in, so we're going to go ahead and wrap up. Remember to join us next week for that. And let me see. I actually do see another question pop up here. One second.
I know that this has just been a ton of information, you guys, so you're welcome to give me a call. Like I said, we teach actually a 5-day class on all this stuff that I'm trying to give you in an hour, so I apologize for all the information.
No, it was a great webinar. I think the information was really awesome. I encourage everybody to join us for the one next week. And I have a question just asking if real estate investors also purchase just, single notes basically to be diversified. And I know from my experience, I do see that. I see people who want to purchase notes just simply so that they can diversify. And as a matter of fact, we see that a lot with self-directed accounts where typically people are not moving their entire retirement savings over to Advanta to make investments, but rather they're moving just a portion of it in order to diversify into other things. So you can certainly keep your brokerage account and then also move over just what you want in order to invest in things like notes and real estate. So we do see that quite often here at Advanta. I had a request to go back to the slide with Michele's contact information, so let me move that back over there for you. And I'll read it out for you too. You can reach Michele at 303-674-0666. 0139 extension 1002.